final episode of the webinar. So let us warmly welcome Mr. Ng Kah Ho. Welcome to the show.
Thank you so much, Ian. It's really an honor to be the last person, especially the last episode to be invited to this webinar. I really feel awesome, and I'm very motivated to really, hopefully by the end of this 1 hour, to be able to share some of the experience, just what Ian mentioned just now. And again, I'm no magician. Hopefully throughout the stories that I'm going to share with you, then you'll be able to realize that sometimes it takes somebody to actually go through some of this hardship, to be able to learn the skills and hopefully to be able to help more people moving forward, right? So hi everyone, if you can hear me, give me a shout out. And I can see some of you, all of you from all over Malaysia. So happy to get connected with you. We were just talking about I just came back from Terengganu, so I was seeing like Melvin, from Jetty, Terengganu. Shout out. Yeah. So let me just share my screen, to get things rolling, right? And I just want you guys to just let me know whether you can see my screen or not. Ian, can you see my screen?
Yes. Yep. Yeah, I'm looking at it right now.
Awesome. Okay. So so today's topic is really it's a very huge topic. I think when I first sent to Ian the original slides, Ian was telling me like, hey bro, you got to cut down and just focus on one thing first, because really when you talk about debt and getting people out of debt, right, it's really a very big topic, right? So I just want to run through with you quickly, and hopefully from the remaining time that we have, we can take more questions. How does that sound like? If it sounds good, give me a like. And today's topic is really about freeing your monthly cash flow through the power of debt consolidation. So just a quick intro. Ian has actually went through the intro, but I just want to go a little bit in depth about how I came through my journey of 12 years and to be able to help so many people, because like I mentioned, personally, I went through that hardship before. So I'm a licensed financial planner, and more importantly, a practitioner for the past 12 years. And like what Ian mentioned, we've helped close to about 70 families and 300 individuals plan up to date. In fact, my claim to fame is how I bought 16 property in 3 months. But every time when I bring this up, it is meant for a learning, because essentially, as happy as I felt during that time, it's really about it was the trigger of my second crisis, right? So that's why we are talking about crisis management here, especially this year. 2020 has been a very tough year. And eventually what we are trying to do, and hopefully what we can do for you in this 1 hour, at the end of this session, we also want to give you some free gift to really set you on the right course in 2021, right? How do you like that? If you like that, give me a like. And this whole story that I'm going to share with you about the 16 property in 3 months, essentially is about the lessons that I've learned, and I want you guys to learn from my mistakes as well, right? And some of the case study that we're going to have today, all right? And yeah, so I'm very entrepreneurial, and I normally want to do a lot of experimentation and experience. So that's why I actually put in my own money to turn around F&B, right? If you have more time, we talk about that. And we did a private crowdfunding where we actually raised 600,000 as an owner in the business, right? So you've heard a lot of people in the financial planning space to actually help clients do fundraising, but you don't really hear a lot of financial planners doing it for their own business, right? So I'm one of the few. So just a quick intro also. I'm really passionate about financial literacy and making sure that people getting the right skill set and doing the right thing and doing the thing right from young. Personally, we didn't have the chance to go through a proper financial education, but thankfully with the government right now, I think they're doing a lot of initiative. I think one of the initiatives was this FEN, Financial Education Network. But before that, before this whole initiative, I've been sharing a lot of financial courses and doing a lot of talks, and that really is the kind of feeling that I love when you actually see somebody transform their life where you contributed to, This kind of feeling, Ian, like, money can't really buy you, And I sort of got addicted to it, just like how you got addicted to Facebook and Insta. So this is the picture where actually I went into a property course, right? Just like many of you on the line potentially that went through many property courses. And then out of the result from the course, I managed to buy 16 property in 3 months. And like I said, it was really, I'm sharing this story is really not to boast, but how we got into it is through a joint venture of 8 people. And eventually the good times, everybody will come together. But especially when the start of 2015, where it was the start of my second crisis, where out of 8 people that joint venture, right, 4 decided to pull out. And can you imagine having an installment of about 30,000? After renting out all the properties, if you divide 10,000 per month installment that you have to pay, it's still okay for 8% to share, right? But I think eventually when 4% left and then only the remaining 4% have to continue to service the installment, I think many of you would be able to relate to that situation. So personally, I was having a deficit of 5,000 per month, right? And the first learning here I wanted to share is if you ever go into a joint venture, right, you want to make sure that the people that you go into the joint venture with are all financially sound as well. So that's one of the things that I learned, right? And of course, lesson number 2 is that when we go into a property deal, the due diligence is a need, no? It's no longer, it's never enough, due diligence, right? But it cannot be to the point of the analysis paralysis, right? So there's a fine line between that, right? So being in that negative 5,000 per month, many of us, if we are in that situation, I think the natural thing to do will be, I got into my depression and the thought of suicide and all these things, and the easier thing to do is to just give up. But I always ask myself this question, like what I recently learned from my mentor, right? The quality of your question determine the quality of your answers, right? So if you like that quote, you can write it down. But I started asking myself this question, what is the biggest learning that God has given me in this challenge here? Because if you know that if we just run away from the situation, the next time it happens again, you still have to face it. So when I ask the question, it basically forced me into a situation of if I can resolve this now, that gives me a better position and raise me into a higher level. Say, for example, this is a level 3 problem. Like what we're supposed to do is to invest into ourselves, learn from the mistake, and grow ourselves into a level 5. So when you're at a level 5 person, trying to solve a level 3 problem is not really a big problem, right? And the next time when the same situation comes in, right, then you'll be able to say, okay, this problem, I've solved it before, right? So that was the mindset at that point of time. And that's how Ian was mentioning that all these magician skills came into the picture, but it's really of going through that process. And I would like to share with you some of it, right? Is that okay? So that's how J Advisory was born. Actually, J Advisory is not a financial advisory firm. It's really a personal finance academy of really trying to empower the middle income family, or rather young families, to really navigate and strive out of their crisis. Because as you all agree with me, all of us will have some form of crisis in our lifetime, right? So not that we are anticipating for it, but why not learning as a life skill, like how we learn swimming, how we learn how to cycle. As once you learn it already, it's part of you and you can overcome whatever crisis moving forward. And really, we want to help create 1,000 millionaire families to really make a positive impact to our community, right? And of course, to begin, we want to do a quick disclaimer. Whatever I'm going to share with you is really simplified and make it very easy to digest and understand. But it doesn't consider any financial advice. But of course, do ask me as many questions as possible towards in this session. Hopefully I'll be able to answer as many questions as well, right? So I just like to start off with a story, or rather a misconception, right? Just like what Ian was saying just now. I think this misconception is something very relevant, which I like to tackle before I share with you the case study, right? So, have you heard of this before? Generally, we think that people who earn a very high income, like 50,000 a month, generally they are somebody who are wealthy. Agreed? If you agree, raise your hand. Right. But I think a lot of in my last thank you very much for raising your hand. I think in my last 12 years, when I've been meeting a lot of people going through that, like what Ian was mentioning, why is there so many professional that still get into financial problem or get into debt problem? Because debt and liability is something that is part and parcel of our life, right? I think gone are the days where people can buy a house with cash lah. Agreed. So, inadvertently, actually, people do have to take some form of loan or debt, no matter how high your income. And I think that's another misconception. Like, if you can buy cash property, then the tax, the LHDM will start knocking on your door, right? But that's another misconception we will have for another day. But I think the other misconception that I wanted to highlight is that most people think that rich people or wealthy people don't have that problem, which is actually not true. Like I said, generally when we buy into high ticket items like a property or a car, generally when we take debts, as we all know that cash flow is king, a lot of the rich people, sometimes they're unable to turn around or monetize their asset. That means they are asset rich, but cash flow poor. Does that make sense? Yeah. So that's why when we couple these tools together, right, then eventually that's why not all 300 people, those professional senior managers all have financial problems. It's just that I started my career as an insurance agent with one of the famous insurance company, but it's just that along the years where my objective is to plan financially, help people plan financially. Not only just, the story was when I got into my first crisis, I was trying to look for somebody to help me to plan because I got into that same situation, rich in asset, but poor in cash flow, right? But eventually I couldn't find that person because the time in 2008, I think is a lot more scarce financial planner. Right now, even in Malaysia right now, we have about 700 licensed financial planner. Right, and we have a lot more insurance agents and unit trust agents. So I went through that phase again, learning it for myself. And when I joined the insurance company, I wanted it as a platform to be able to practice so that I can help my clients. So that 300 individuals that I was helping is more of the clientele from that point of time, right? So that's why I just want to lead you from this misconception to a beautiful story that one of those people that actually came to me at the point of time while I was still in the insurance industry, right? So this person have actually just got married and have a beautiful daughter. And how he got into a 70,000 debt, but 70,000 in those days in 2008 actually is quite a lot. No? And how he got into debt was he ventured into a business of F&B, right? And it's very if you look at all the statistics by Ben Negara, you notice that two things stand out. The two main points always stand out, especially when people get into debt. One is actually medical costs. You know how you don't have medical insurance, and then you have to help pay for your relative, your parents or your siblings. The other point is always about business failure, right? So eventually they started this F&B, was doing very well in 6 months. But when the landlord saw that they're actually doing very well, they actually increased the rental. That's how they actually got into this, because they couldn't manage from a business point of view. And eventually he was actually one of the senior manager in one of the big four companies, right? So, but when he came to me at the time, having this debt, he wasn't sure how to turn around. So this is one of the earliest experience that I had helping somebody. And at the point of time, we really helped pro bono lah. And he actually wrote me a very satisfying or very inspiring testimony, which by sharing with him some of the things that I'm going to share with you today, of course I can't share, but especially this thing called Aisha. I mean, if you guys have time, you go to my website and there's a free class that you can go through and learn this system. Basically, everybody needs to learn it, right? By just applying this system, right, he basically able to turn around that 70,000 debt, managed to buy 2 properties worth 1.7 million in 3 years, set aside 500 per month for his daughter's education, and have this saving habit of 3,000, 4,000. So in the sense, one of the biggest problem that most people have when they get this kind of debt is they normally try to settle it and then they compress it into a very short time. So your installment of paying the loan is very high. So you can see here, he was having a 4,700 commitment, but after when we help him to, like you say, do some magic. I'll share with you the magic lah. It's not really magic, but we help him to turn around and reduce it to 1,003 by extending his loan tenure. Right? Are we okay so far? Any questions up to here?
No. I mean, just carry away. It's
awesome.
all good. Of course, if you have a question, they will put it in the Q&A box. So at least
cool.
all of us get the gist of the stuff. Yeah.
All right. Awesome. So I just want to then lead to my next sharing, which is really a case study. And this person actually came in when I started J Advisory this year. In fact, J Advisory was started in April out of the COVID, because I felt that, hey, I went through my 3 crises, and nobody in their right mind should go through this tough times. So I felt that there's this calling for me to be able to do these classes. And this was one of the first person that came into the class. And when he came to see me at the time, again, like I said, when we are so depressed and so stressed, sometimes we cannot having a deficit of about 18,000 per month, right? And we actually share this case study in our Facebook, and we wanted to share how we help him to turn around and save 10,000 a month, right? So the story here is that he's also a business owner, and we always like to help find the root cause of the problem before we sort of start mapping out the strategy, because if having, it's like cancer, you basically need to find where the cancer is. You need to cut it out first, and then only start treating the person. You can't treat the person when the cancer is still in the body. Does that make sense? So when I talked to him in our one-to-one, he basically told me there's the three things that happen. One is some of the business failure he had in China. I think a lot of people actually try to expand to China at one point in time, when China was booming and China was the best place to do business. So he went as well. And of course, the other part of it is similar like me, where he got into some of the property deals and some of the partners dropped out. So that's how he raked up this 18,000 per month. So if you go in a bit deeper, right, this is what I mean by the first misconception. Do you agree that 27,000 is not 27,000 per month income is actually a very high income? If you look at the how our government define it, you have the B40, the M40, and the T20. When I'm trying to tell this guy that he's actually the top 20% in Malaysia as a income earner, right? He said, "Where God, I'm just a middle class, But because why he's saying that is because of the commitments and expenses that we have. I think you all agree with me that in Malaysia, our income generally hasn't gone up that much, but expenditure and commitment has gone up maybe easily 5-fold or 10-fold, right, Ian? So if you break it down, right, you can see that the most eye-glaring one was this. This is what we mean by cancer, the money cancer. So this was because of the business failure and also the property installments that he have accumulated and converted into personal loan and credit card debts, right? And after going through the I wouldn't call it treatment but going through this turnaround process, I'm going to share with you how to do it right? We basically help him to save at least 10,000 per month by doing a debt consolidation. So what is a debt consolidation? Debt consolidation is basically just trying to, because he has about, this particular slide here, he basically have different loans. And what debt consolidation means that you're trying to put all these loans into one big container, right? And in our classes, we actually introduce this term called IBR rate. It means installment burden ratio. So what does installment burden ratio mean is that it's a calculation to basically show you which of the loan is of the most burdening to the individual, so that we need to consolidate first. So when we went through with him, we basically did this, right? We basically put all the loans together into one particular container, big enough to house all the loans, right? So when we did the calculation just now, we saw that in total there was about 880,000 loan, right? And he was contributing about 24,000 per month. So when we put it all together into this container, we basically lengthen the tenure or the term of the loan, right? So this is the magic part. So we lengthen the term of the loan, but generally most people think that, are you crazy? You lengthen the term of the loan, basically you're paying more interest, correct? But eventually, this is a concept that everybody should know. In terms of interest, right? Sometimes interest is something, because we cannot see it, hence that's why it's very hard to manage it. So there's this term called a reducing balance interest, and there's a fixed rate interest. So in reducing balance interest is interest where they calculate as you pay your loan. It recalculates every month. I mean, it depends on your loan. It can be daily, monthly, yearly. I think those days we have yearly loans. But the fixed rate loans, right, or the fixed are those like, personal loan and car loan where they calculate the interest upfront. So no matter how much you're paying to it, you basically fix that interest calculation already. So I felt that a lot of people couldn't understand this. That's why when we went through this so-called magic, we basically took all his personal loan and credit card loans and put it into a container which is a housing loan, right? Because a housing loan typically is a type of reducing balance loan. Then a lot of people will be asking me, hey, is housing loan the only type of reducing balance loan? No, actually, some of the car loan right now are also reducing balance in nature. I think you can go and check it out. So that's essentially how we help this person, put it into a container first, lengthening it for the loan term to be longer, because instead of paying it in 3 years' time or 5 years' time, we lengthen it to 10 years. But the catch here is you need to understand that at the end of the 10-year payment, the interest calculation needs to be much lower than the original interest that we're paying for. Am I going too fast, Ian?
No. It's perfect.
Okay. So essentially, right, when we understand these three components, then that's how we do this magic of debt consolidation. But of course, the disclaimer here is that the first priority, any person that we work with, we would do the lengthening and the reduction of loan interest. But there are some cases which is very chronic, that needs, like, how you need to save that person's life already. Sometimes we have to just reduce the installment first and not take the interest calculation in totality as a start, because we need to save him out of the deficit that he's currently facing, right? It's a case-to-case basis. But in all goodness, we want, the ideal situation is to really reduce the installment lengthen the term, and also reduce the interest. That is the ideal situation here. All right. So if you guys are learning something, give me a like or raise a hand, just to make sure that I know that you guys are still with me. Thank you very much. Wow. 12, 13, 14 people raise their hand. Okay. I'd like to go on, right? So once we finish with this case study, this is the part where I'd like to give you a gift. Because if you notice just now, right, there's a lot of processes, a lot of steps. But I would like to give you guys, if many of you are in the similar situation, right, you want to have an actionable step. Agreed? So I want to give you the first thing first before you get into step 2, step 3, step 4. I want to give you this gift, which I call it a financial compass 1.0. Is that okay? If it's okay, give me a like. So financial compass here, what it really means is similar like a life, like a compass. Basically it points you to the right direction, and hopefully in 2021 it helps you to find your true north. Because a lot of us are basically lost, right? Because we don't know, we know physically where we are. We're located at all those locations that you guys type, but financially we don't really have a clue. Agreed? So from there, that's why in our classes we actually share this financial compass for you guys, so that you know exactly where you are financially. Then only you can begin to take the steps of turning your situation around for the better in 2021. All right. So we call this a MND calculator, right? And the MND calculator is actually developed based on this famous book by Dr. Thomas Stanley. He's the author of Millionaire Next Door, hence why MND. And I just want to share with you another scenario of this person that actually came in, and how we use this MND calculator to help him begin the transformation. All right. So this person, when he came to see me about 2 years ago, 2018, the blue bar is the asset. Asset is what we own, right? Like your property, your car, your money, your investment. Liability is the red one. So when you see a red more than a blue, technically this guy is insolvent or bankrupt, technically, right? But after 2 years, when he did this exercise with me, and in fact, if you guys can, I'll recommend you guys to do it every year, right? Because it's like your health check. Every year you have to do it. So similarly, your financial is also require this health check. So after 2 years, we basically help him to turn around, and because he found his true north, right? So you can see that he's very focused on building his asset, and although liability was higher than before, but again, the focus here is about building your net worth, right? So in case some of you are asking me what is net worth, essentially net worth is what you're going to retire on, which basically means your asset minus your liability, the net part of it. So why is net worth so important is because, like I said, it is really what you're going to retire on. All right. So let me share with you in detail what I mean. So when he came to see me at the time, his net worth was a negative net worth. So that's why I say technically he's insolvent or bankrupt. But thankfully, his cash flow was very strong. So you can see the 2 degree, the extreme examples which I share with you. The first case study I share with you, the guy is asset rich, but cash flow poor, right? Over here, I'm sharing with you that this guy is asset poor, but cash flow rich, right? Then you'll be asking me like, hey, which one is easier to solve? Definitely, if you are asset rich, cash flow poor is easier to solve than this example that I'm going to share with you. So after 2 years, we basically got him to focus on doing the things right, finding his true north, and that's why you can see that in the 2 years time, in our program we talk about 10x their net worth, but this guy outdid himself. He basically about 180x. But there's a side effect for people who go through our courses, is because once they find the true north, right, after when they start to turn around the transformation, they do a lot of property investment. Not that we purposely, show them or coach them that way, but that's a natural tendency we see as a after effect, lah. So that's how he actually got his investment asset so much higher, because he actually bought two properties, and we basically sort of turn around. Remember just now I was talking about the debt consolidation part. We did the same thing for this guy as well. You can see the short-term liabilities. We basically turn around and move it into long-term liabilities. That's how we also managed to get him getting this result. So essentially, this is the part which I wanted to share with you as a gift for 2021. If you guys are very keen about how to find your true north, you can do it now after I share with you this explanation, or you can do it later at a time where I'm going to give you a QR code and a link if you don't have a QR code. But just let me share with you, how do you find your true north using this M&D calculator. Is that okay? Now, after you fill in some of your information, right? I know most of you don't have your information with you, but what I want you guys to do is to do a guesstimate, right? So I'll walk you through the instruction later, and once you submit, then you'll get a report personalized to you. In fact, this gift in our engagement with our clients, we actually charge about 1,500 ringgit. The 1,500 ringgit is actually composed of two parts. So for this part, which is part one, this is my gift to you guys, worth 750 ringgit. So I want you guys to pay close attention if you find that this is something which is going to be helpful, or if you're in a similar situation like the earlier two gentlemen, right? So the result after when you get this, I just want to spend some time sharing with you, because how do you interpret it, I think it's more important, right? About how to find your true north. So I'm going to give you two examples here. One is that you're going to get a result which is your M&D percentage is below 100%, right? And the other one, of course, naturally is above 100. So what does below 100 and above 100 mean, right? So let me just share with you step by step. So below 100, right, it basically means that, can you see here? Under accumulator of wealth, or average accumulator of wealth. Means to say that after you've keyed in your asset, right, and your total liability, you will have this thing called a net worth, which is what you have right now. And based on your age, based on your income, right, you basically have an expected net worth, right? So Dr. Thomas Stanley used this method basically to find out if, let's say, Ian, if you are earning 10,000, right, having a 1 million net worth, and then I'm earning 20,000 per month, and I'm also having a 1 million net worth, he was trying to answer this question: who is better at growing their assets? Right? Is it Ian earning 10,000 per month but also having 1 million net worth, or is it Kaho who's earning 20,000 per month having 1 million net worth? What would you say, Ian?
Hard to say that. It depends on the person's age also, right?
Same age. Let's say we are both same age 30.
Oh, that I don't know lah. It could be, there's so many factors. It could be, let's say, the net worth, right? Let's say the 10,000, maybe, who knows, he growing stock and then his net worth go up. I don't know lah. Okay lah, I'll bet the 10,000 lah. Let's put it there.
Correct. Yeah, essentially, what we're trying to measure here is like what you say lah, how healthy the person can grow his asset. So for example, if the person, like, you are 30 and I'm 30 and we're earning the same, you're earning 10,000 lesser than me, and you have the similar net worth like me, would you say that you are the better person at growing your asset compared to me because I have double your resources but I only do the same?
True.
Do you follow? Yeah. So essentially, this calculator is to measure that. That's why they actually have your current and then they actually have an expected based on your age and your income. So when you see a 24%, which is below 100, basically this guy, when he came to me, he's basically asking the question like, how do I grow my money better? I put most of my money in FD. I'm so depressed about a 2% or 3%, you know. So that's why this is trying to give you an objective view that, hey, I've got a problem. The problem is either I don't have enough savings, or I don't start to have enough savings, or I don't grow my savings fast or healthy enough. That's essentially what we're trying to drive here. That's the first step. As compared to this person, right, you can see his total asset is 2.6, his total liability is 773, and his current net worth is 1.8. He's only expected, based on his income and age, only 882,000. So his percentage is above 100%, which is 208. And this guy is actually growing his assets very well. But of course, are all rich people or wealthy people free from financial problems? No. It's just that their problems are different, right? This guy will be asking a question like, how do I earn more but paying less tax? How do I preserve my assets for my next of kin, you know? So that's why I want you guys to do this exercise for yourself, to be able to give you an objective view of where you stand. Then you begin to know what are the steps to take, you know, to transform your financial moving forward in 2021. Are you following? If you're following, you know, give me a like, give me a thumbs up. Yeah, thank you very much. So if you're ready and you understand, this is the part where, I mean, if you guys don't understand, it's okay. You can just repeat watching the video over and over again until you get it, right? That's the beauty of FB Live nowadays. So this is my humble calculator, which we developed ourselves. And I'm just going to go through quickly so that you guys understand how to do it, and you can do it at your own pace and your own time, right, and your own space. But most importantly, you need to be able to key in the right address, because if you key in the wrong address, then your report will never be sent to you. So you want to key in your full name, your age, right? If your age, let's say for example, your birthday is 31st December and your age 30. So right now you should be 29, right? So you want to key in the current age that you have, which is 29. Over here, annual income, you want to key in, let's say you're earning 10,000 per month. You want to annualize it times 12. You want to key in 120,000 here, right? Then you click next. Now this part, like I said, I know that all of us don't have all the numbers with us. It's okay. Just do a guesstimate. But later, when you have your numbers more accurately, you can redo this exercise as many times as possible, right? So you want to key in your EPF. This EPF consists of account 1 and account 2. A lot of people forget that the majority of the assets are in the EPF. So if you started investing in unit trust, share, or property, you want to put the market value. Say, for example, you invested 10,000, right? And then right now, the market value of the unit trust, say, for example, is 20,000. You want to put 20,000 here. Same goes for your share, and same goes for your property. So in case some people are asking, like, property, what should I put? I bought it at 300,000, but the value right now is, say, 400,000. So you put the 400,000 amount. Anything that doesn't fall into this four key category, you just lump it up under other assets, you know, because you have your gold, your cash, some of you have Bitcoin, etc., right? Okay, once you're done, then you go to next. This is the part where you key in your liability. Again, I know that you guys don't have the number. Just do a guesstimate, right? So, for example, if some of the people who are more hardcore property investor, they have like 5 housing loan. You want to put your current outstanding amount. Say, for example, you got that property, your loan originally was 400,000, but right now after paying it, you only left back with 200,000. So you want to put the 200,000 here. And if you've got 5, you multiply times 5, so you put 1 million here. So same goes for personal loan, car loan, and other loan. You want to put your current outstanding amount. I know you don't have the amount, just put a rough estimate. You know, once you click submit, then you want to check your spam folder, because after 2 minutes, if you still don't get it in your inbox, you should get it in in your spam folder, right? And yeah, from there you'll be able to go back to this screen to see whether you are 100% above or below, right? So yeah, thank you very much. Got form link, yes. So if you guys are keen to do this exercise, if you have a QR code, you can just scan the QR code. If not, you can just type in this link. Right, you can just snapshot in every life if you like to, and
Right.
yeah,
Just give me a moment. I will just
sure.
type in and put this calculator. It's just CALC, right?
Yeah, CALC.
Okay, I've typed the link at the chat box, so you can actually just click onto the link at the chat box and you will get the MND calculator. All right. Yep, thanks. Back to you again.
Yeah, so that's really the end of my sharing for today, and we would like to take some questions as we have some time. Like I said, we want to spend a bit more time answering questions today, right?
Okay.
So yeah, back to you, Ian.
Yep, sure. All right. First and foremost, thank you so much, Mr. Ng Kah Ho, for such a wonderful sharing. It's a very insightful sharing session, by the way. And of course, if you have any questions, now is the best time to do so. Personally, I have actually gathered quite a number of questions. All right. In fact, one of it, right, I think because of time, right, we can actually spend some time on this question because
Sure.
because he asked a very good question, all right, and it's actually but I asked him to actually be a little bit more detailed so you can see how you play around with it okay. So this one is by let's call him Adrian all right. So here's what Adrian said. So it says, hi Kah Ho, I basically have the same issue here, having around $80,000 in debts. Monthly repayment is about 4 to 5K. Seeking better way to reduce burden, which is where because they are almost buried, I'm almost buried in this debt stuff, and then I cannot breathe. Then what happens is that I asked him to actually give a breakdown. So the breakdown is as follows. All right. So basically, okay, I'm gonna just read out. Installment per month. So personal loan is about 1,550 per month. Personal loan. Mortgage is 1,750 per month. Credit card debt 1,700 per month, and hire purchase loan 585 per month. Okay. So basically that is the status, and he is actually paying about 4 to 5K in monthly repayment. So how to go about it? How to do magic trick?
You mentioned he said that he have a total of 18,000 debt. Is it outstanding debt? Is it
80,000? But wait, let me. Okay, I think the 80,000 is not exactly 80,000 Okay, but after he gave me the breakdown, right? Okay, he gave me some very good details like mortgage outstanding is 330K, and
Yeah,
credit
because
card.
when I saw the mortgage there, definitely it's going to be more than 18 one. I think the 18 maybe he's referring to is the personal loan, the credit card, and the car loan.
So all in all, I think he has $430,000 in debt All right.
430.
So mortgage is 330K, and then credit card he has about 15K, and hire purchase is 15K, and then we have personal loan 70K, more or less
So I think first thing first is to set the expectation right definitely we won't be able to resolve doing the magic right here in the session, but definitely in this session we probably can give him some pointers. Normally when he say that there is I think fortunate and unfortunate enough to get all four types of loan, which is normally very frequent that we've seen. And I think on the top of our mind, what we can help him directly is the when we did the calculation of the installment burden ratio, normally it points out the personal loan and credit card are always the most detrimental, the most jialat one. Right. So first thing first, he want to look at the personal loan and the credit card one to see is there any way of doing the debt consolidation. And I think in the chat there, I see a lot of questions, but pardon me if we cannot answer all, but there was somebody asking AKPK, right? Because they're talking about debt consolidation, the first thing that comes to mind is AKPK. So definitely that is one of the ways that he can go and seek out for help. Because AKPK has the power to actually negotiate with the bank to actually help you to reduce the installment within your repayment capability. But as we all know, there's always pros and cons, right? Even for us, when we help our clients, there's also pros and cons. And what we want to share here is that the AKPK can't really help three types of people. Number one is actually people who have total debt more than 5 million. They can't help. Number two, they can't help people who they lost their job because they have no active income, because then they can't have active repayment, right? And number three is they can't help people who are bankrupt, right? So over here, I think somebody was also asking like, hey, what is the cost of us doing the debt consolidation? I think we're probably being very fair because I've been in the same situation before. I think this Adrian guy, right, if he really wants to actually explore further into how he wants us to help him, I think the option right now is, number one, you can go to AKPK, but AKPK just only reduce his repayment, but probably increase the term, right? But it doesn't necessarily mean that he's actually saving interest in the long run. So our value proposition here is, if it's possible on a case-to-case basis, if we are able to help him to lengthen and also save him the interest, right, we probably will charge a percentage on the interest saved. Say, for example, we help a couple of clients, right? We managed to save him about 100,000 of interest. So we actually charge between 15 to 30% of the interest savings, which technically he's supposed to be paying the bank anyway. So out of the effort of helping him to save, that's where we will charge. But again, it's on a case-to-case basis. Right. But to answer the question, he should really look at the personal loan and credit card first, because normally these are the most burdening. And I'm guessing, you mentioned personal loan 1,500, credit card 1,700, right? I'm guessing the outstanding amount is not a lot one. And with a bit of tweaking, we can probably, good thing he has the housing loan, we can probably use that to help do the debt consolidation for him.
Yeah, I believe most likely case will be that which is to I do not know how much is the value of the house Maybe you can, I don't know, get a top-up loan or a refinancing stuff, and then you get the money.
But I just want to add on, as simple as we share in the session today, but I would recommend those people who really want to do it to really seek professional help, because you don't want to do it on your own, and one wrong move could actually cost you more than you initially intended for. So that's why we're also very careful on the cases that we actually help.
Okay, so in that case, there's another question that comes in that says, how do we get in touch with you? Maybe you can just put up the the slides where it has all your contact details. Then we can move on with the other questions. Okay, so as you can see, these are the places where you can actually find Mr. Ng Kah Ho. So it's all listed here. So we are going to just maintain the page, all right, just in case you want to get in touch with him personally. All right. So if you're Adrian, you want to know how to actually save on your interest costs and stuff like that, then this is the place. Perhaps you can actually, be in touch with Kah Ho. All right.
But like I say, Ian, I think for Adrian, right, I mean, even before they come in for us to help them to do the debt consolidation, we really want them to come in and empower themselves to be able to learn all the basics first. That's why we have these classes, and we have a lot of free classes and some paid classes, for them to be able to pick up. That's why all this link here, especially our Telegram channel, our Facebook, and our website, you can actually go in there, and there's a lot of content that you can watch for yourself to even start doing some of the fundamentals.
Okay, so let's move on to the next question. So actually, just now you pointed out some AKPK, the difference between debt consolidation and AKPK, right? You mentioned that, but I just want to discuss another point is that like if let's say a person goes through AKPK, right, which means actually another con that I believe is this lah. Sometimes you don't really need to go through AKPK, because if you go through AKPK, then your future loan application will be like for the time being lah. As long as you're under AKPK, you can't actually get a new loan. But some of you guys may not be in that dire straight kind of like the desperado kind of this kind of situation. So if you do the debt consolidation right, is it possible that once you get it right, then actually you're still eligible for future loans if you really want to lah? So what's the take on this?
Yeah, actually, I'm glad you brought that up, Ian, because that's a very taboo topic, which a lot of misconception came in. First of all, I'd like to just say this. For AKPK to be doing what they're doing, it's really not many countries actually have the kind of program because they're doing it for free, right? So that's why a lot of cases that we see, which is very straightforward, and the people that came to us, they sort of lost their drive to do it on their own. Then we normally show them or introduce them to AKPK. But I don't think it's a wrong thing for AKPK to do, because they don't blacklist you. I think a lot of people or confused that they think that going to AKPK is actually blacklist. It's not. They actually put you into a watch list where they want you to finish paying off the current loan first, because imagine having an ice cream, having 3 scoops. You cannot even handle 1 scoop. So they want to make sure you pay off the loan so that you can actually get back on your own 2 feet before getting the new loan, right? And I think that is the right way to do it. It's just that for people who come to us, which we see that they have the drive and the motivation, that they want to not only just get themselves out of the situation, but to be able to have the chance and opportunity to capture, crisis has a lot of opportunity. In fact, in the next 6 to 12 months, we see maybe there's a lot of opportunity in auction property and to sort of capture. So we encourage these people to engage us, right? Where definitely there will be a cost of engagement, but in a sense, they don't have to wait out the entire period of continue to pay off that loan that they're supposed to pay. Say, for example, if AKPK structure them for a 10-year loan, and in actual fact, through this debt consolidation, they actually maybe need 5 years because of the interest that they save, right? So that cost benefit analysis, that's where we will work with certain individuals of helping them to turn around.
I see. Okay.
I hope you answer your question though.
Yep. All right. Then we move on to the next one. This one is from Miss Yo. So Miss Yo asks, if the person doesn't have a property, right, still can do debt consolidation or not?
Still can, but it's a bit more challenging because this is the first rule that we introduce in our classes. So you want to restructure some of the high interest, like just our Adrian's case, for example, the personal loan and the credit card, right? Let's say you find out that it's 18 or 20% interest, right? So debt consolidation can still be done without a mortgage, but he needs to go and find out a low interest container. Say, for example, you can get a 5% or 6% that can allow you to drag it to maybe 5 to 10 years. Then effectively, you're lowering your interest and your installment at the same time. So the answer is yes. But you need to do research. You need to make sure that you know you're getting into the right scheme.
Okay, so the next one, this one is from Robos. So Robos asks, at the beginning of this webinar, right, you mentioned that this is basically for young families. How about those people who are above 40 years old or where the family is single income family? Can they still go through this kind of debt consolidation?
Actually, this debt consolidation is open to anybody. It's just that why J Advisory is helping young family is because generally this group of people they have so many priorities that they have to manage. You have to manage your family, you have to make sure that your career is progressing well, and finance is always something which is the last part of our thought we ever think about, right? So I guess being in the same demographic, understanding the pain and the challenges, hence that's why we want to help this group of people first. It's not to say that other people we don't help, but we do get a lot of people from single family, single or even 40s coming into our classes, and and having that kind of results that they aspire to have. Yeah.
Hey, then in that case, all right, let's move on to. Okay, this is a very interesting question. Just want to get your thoughts on this. This
Sure.
one is by Su Yi. So Su Yi asks, what do you think about buying a car using? Okay, there are two types of loan. Number one, you use a typical car loan, all right. She bracket there, reducing balance car loan. All right, first one. The second one is that you already have an existing house loan, but then you refinance your house loan to buy a car. What are the pros and cons? Which do you prefer? How would you advise? Yeah.
I think Sui is a very creative person because I think she can read my mind because I'm one of those people who did that. Because at the part where I did that, right, there wasn't any option for car loan being uh, financed in the type of loan where I mentioned is a reducing balance loan. It's just that only these last 2 years I've seen the emergence of this. So the question here is definitely yes, if you are able to calculate and ensure that the reducing balance loan in the entirety of that loan, it, it has more savings than what we take in a conventional loan. So we actually have this uh, case study in our classes, right, where we will take a conventional car loan, let's say for example a 3.5%, and then another which is a reducing balance loan, maybe like a 4.8. So naturally, a lot of people think that hey, 3.5 should be lower than 4.8, but the end calculation, when we did the calculation, the 3.5 is the typical, the calculation of the interest is upfront, and then the 4.8 is a reducing balance loan, right? So when we did the calculation at the end of the day, guess what? The 4.8, although it's higher, but the effective interest payment is much lower. So that's why I mean by, a lot of people needs to understand that the calculation of interest, because interest is something which cannot see. And this is the part where I want to fine tune or pinpoint to Sui. As much as reducing balance should be the right way, but you need to also take into consideration the interest rate. Because if the reducing balance interest rate is so much higher, that the end of the whole loan is going to be higher cost than the fixed rate loan, then you want to make sure that you make the right decision. Does that make sense?
Okay. Next one. This one is by Chi Hong. All right. Chi Hong asks, what do you think about borrowing a personal loan with 5.9% interest? All right. Loan tenure 5 years to settle a personal loan of 10% interest rate, which has 3 years left. So what do you think about this?
I used to ask a lot of this kind of question to myself, but if you want to get clarity, you really want to put it down in paper calculation before you make a decision. Because right now, just by putting that, There's a lot of numbers there, and I think the typical person will get confused. So many numbers, 5.9, 3 years. So once you put it down, recently I did a case study. I think if you join the Telegram group, there was one of my students that basically asked the moratorium of a car. I think many of you are asking this question. Should I take the moratorium of a car loan, right? And when this student of mine gave me this calculation, and we did the calculation after the moratorium that he had for some time, but the loan was extended and with the interest compounding on it. When I did the whole calculation for him, right, then he could make the decision very easily because the extension of the moratorium basically almost doubled his interest calculation or repayment at the end of the whole car loan. So when you put it down side by side, then it will give you clarity. Yeah. So if you guys want to access the case study, I think you can join the Telegram. Then because Telegram have this history, you can just scroll, and you can find the case study there.
I see. Okay. Next question. This one is by Kelvin Chan. So Kelvin Chan asks, I'm currently having very high monthly cash outflow for mortgage payments due to some failed joint venture property investments in the past years. I need to find a way to reduce my monthly cash outflow. How can I do debt consolidation in this case to reduce the monthly mortgage payment? This one's from Kelvin. Yep.
This is a very challenging question to answer here because we don't have the details of it. But what I would say is this, I think there's a stigma to being bankrupt because although Ian, I think you mentioned about the magic. The truth of the matter is that the magic cannot save everyone, right? Especially with property being, I think I'm quite lucky in a sense that with all the financial planning skills that I learned along the years, it sort of helped me to survive it, and that's the reason why we want to help as many people as possible. But we do come across certain cases where it is too late in the situation that the better way to do it is to declare bankruptcy. I'm not saying this because I'm encouraging that, but I'm saying this is because bankruptcy has been always a stigma that a lot of people don't really understand to begin with. So to really answer the question of Calvin, definitely we need to understand the detail of it to see at which point is he past the point of no return where he needs to declare bankruptcy, or is he something that we can still salvage, right? And but what I want to share with you here is that I think the government recognizes that the bankruptcy rate is getting higher and higher, and I think they also doing their best trying to move the bankruptcy. In order for you to apply bankruptcy, it used to be 30,000. I think it's shifted to 50,000 right now. I think there's some plans to move it to 100,000 because the fact here is that as long as we borrow money, we need to return. I think that's the first principle, the ethical, responsible borrowing. No? But of course, there are people like myself and other people who got into the mistake of not knowing and experimenting. And right now going through that crisis, right? So, yeah, I think it's about the understanding and at which point you are, so to see whether you are able to turn around. But if you're sitting on it too long, too late, yeah, unfortunately we can't really help everyone. I think that's the fact.
Okay. Next one. This one is by a 60-year-old man. All right. So this is from Raja Sekaran. So all right. I think this one is a bit hard, but let's see what is your advice. Okay. So he says, I'm 60 years old, able to pay back loan. However, banks refuse to give loan to buy properties for investment, quoting my age, too old to get loan. Please advise.
Yeah, I think the banks do put certain age limit because I think the maximum loan um, eligibility, I think at one point of time they extended it to 70 years old. Now I think they reduce it back to 65. I'm not sure, correct me if I'm wrong. But I think there's a valid reason to that because generally when you're 60, it's normally nearing to the age of retirement. And we've worked with many people who, at the age when they're buying property, it actually gives them more stress than pleasure. So I'm assuming that Raja, is it?
Yeah.
Yeah, Raja, perhaps maybe if he really wants to buy a property for his own stay, I'm assuming that he's been renting for so many years and probably he came to the point where he realized that, hey, it's better to buy a property than to rent, right? Um, there's other ways of how he can overcome this, right? Naturally, if you're 60-year-old, I presume that you have enough savings to buy the property cash. And normally we don't advise people who are at the age to take a loan because of the stress, not having an income and having to service the loan. But if the first scenario where you did not actually accumulate enough savings to actually buy cash of the property, perhaps the property is also too over what you are supposed to be getting, right? And um, if it's not, then the other option would be to joint venture or to be like a
Get your
joint
kids off
borrower. Yeah, joint borrower with your kids, because your kids are having that what's that?
age.
Yeah, the earning income capability, so getting your kids to be a joint borrower or getting your kids to take care of you, I think being a parent that you've been grow upbringing your kids so long, then I think it's only right for them to take care of you.
Okay. Next one. Okay. Running a little bit out of time, so I'm gonna just last question, and that's about it lah. All right. So
Sure.
Zafifi asks, can someone do a debt consolidation if expenses and loan exceeded his monthly income? Like for example, net monthly income 4,500, monthly expenses and loan 6,000. Every month down by 1,500. Still can do debt consolidation or not? Or do you advise him to do debt consolidation? Please advise.
Based on the example that we gave just now, I think his question, if I understand correctly, because just now we did the case study, he was also exceeding his monthly income,
Yeah.
right? So the answer is yes, but I think his question is more on the fact right now that I exceeded and my decrease perhaps doesn't allow me to borrow some more from the bank, right? So I think that's more of his question. So in order to answer this question, right, bank is not the only source of borrowing, right? So there's this thing which we call creative financing. Creative financing, but it needs to be done in a proper manner. The first law or first rule is that whatever money we borrow, we must return. Right. So what I mean by creative financing is that there are people that came to our classes, which we actually assess the situation, they cannot borrow from the bank anymore. Then the next part is we actually work with them on how do we raise funds through their friends and family with the intention of doing a win-win. Say for example, you have your friends and family who are actually looking for higher return, right? Like FD. Right now it's giving like 2%, right? FD used to be 4%. So a lot of people are on the other side looking to increase their asset return, right? And if you are going to go to the bank getting a loan from a credit card and personal loan, which is 20 and 18%, why not structure something in between, where it's a win-win? if you were to give that person that you're going to borrow from a 5% return on their FD, but with the intention of making sure that you repay every single cent, right? And then that person is going to already gain 3% interest, right? For you, you already save almost like 10% interest because instead of going to the bank, having to pay 18%, you're only paying 5%, you're saving 13%. So this whole concept actually came from, how WeChat used to start this P2P lending. Unfortunately, in Malaysia, we haven't had that peer-to-peer lending, P2P lending. So far, it's only up to the point where some of the platform by the Securities Commission, they only allow it, the borrowing for businesses, not for individuals yet. So I think it comes with education, and that's why we are actually talking about getting empowered with financial literacy and financial education is because once you understand all these concepts, it's not to say that. I think the question is always about Ian, would you borrow to a friend? I think it's very challenging, right? Because there's this emotional part of the relationship, and the money is a separate thing, right? But I think the moment when you say no, you're sort of saying no to the friendship. But if people are mature enough to be able to dissect it as two different things, right? And understanding that the good relation is also coming from the trust. That's why we have all these secrets and CTOS. It's basically to be able to quantify how trustworthy you are as a person. But of course, if you are not being trustworthy for so many years in your life, then that's a reflection you got to do, But the answer is yes, there is this thing called creative financing. I hope I answered the question.
Okay. All right. So final two questions. The first one, Nasruddin Sultan asks, I have two housing loans, want to make it one into one. Two housing loans become one. Can do it or not? Or possible to do it and how to do it?
I think the bigger question here is why he wants to do it. The how is always possible. It's all about the why. If he is feeling that he wants to consolidate it because he feel that he can reduce the installment of it, that would probably be a bigger why. But also other consideration that he need to understand. If you have two property or two housing loan, I'm assuming that one is for investment, the other one is for own stay lah. Then the question of why would you want to consolidate investment property into mixing up with your residential property? Because when you invest and you rent out the property, right, I'm assuming that the rental is going to help you to pay off your interest. So technically, other people is paying on your behalf. Technically, you don't have to consolidate it. So you need to go back to the why. But the mechanism is there if he wants to do it.
Okay. Last but not least, so this one is from Susan B. So Susan B says, didn't hear you very clearly. So okay. So basically here's what she says. Susan B, all right. The cost that you charge and that you charge people, your clients to do debt consolidation is about 15% to 20% of the interest savings safe. All
Yes.
right, from it. So that's one. So she asked, what's the minimum criteria to qualify for a debt consolidation kind of service? And number two is that how much minimum loan amount is best to do a debt consolidation?
I think if actually the real answer to the question is really depending on the severity of the person coming in, because ultimately the whole debt consolidation process is about helping that person get a new lease of life, right? But I think if she's asking from us as a planner or a consultant to be able to help him to make worth of our time, basically we've been working with people, their debts is starting from 100 to 100,000 onwards. Then it is something which we can take a look. Yeah. We've done before debts amounting up to $1 million before also. Just personal loan and credit card, not inclusive of the housing loan yet. But again, the more complex it is, then hence why there is a range there. Perhaps there's more time, that more attention to details that we need to put on. Hence, we need to put in more effort. And again, I still want to mention this, that ultimately, we still want to invite all of you to go through the proper financial education, because when throughout this question about having the resolve that specific problem, right? If you don't focus on making sure you are being that person who can have the proper financial management, right? Eventually, the problem will come back again, right? So that's why we will put a lot of effort in the education part, because we want to make sure that, hey, you are good at doing it already. Then we solve the problem. Then you are okay. Then you're happy,
I see. Okay, once again, thank you so much, Mr. Ng Kah Ho, for such a generous sharing session. As we actually, I believe we have actually answered more than 10 plus questions regarding on debt consolidation. So really thank you, really appreciative of your effort when it comes to answering all these questions. And of course, in the future, like 2021, of course, we would love to actually get you back if you have the time and if you're available lah. All right, so that one we can actually plan that out after this webinar. And of course, in our pipeline, what I'm looking at right now is that our next week's webinar, right, will be held on a Wednesday, not on a typical Tuesday like what we are doing right now. So it will be a Wednesday where we have people from Philip Capital, where we are going to talk about CFD. All right, how does it work? Okay, so that one we will be talking about that. And of course, there's a few lineups, like for example, if you have been watching YouTube, where we have Mr. Money, all right, Peter, the CFP guy, all right. So we have Mr. Money TV, that guy coming on to our platform, and as well as Stanley Lim, all right, who's actually going to talk to us about stocks. He's a very interesting guy. Always learn a thing or two about his way of investing in the stock market. So that one is actually being lined up in the first half of January 2021. Oops. Hello? Yep. Still there?
Yeah. I'm here. My internet got a bit cut off.
Oh, okay. I thought what's going on. All right. So anyway, I mean to say thank you so much for your participation. This is really okay. Sorry, the lineup of webinars. Let me just repeat. Okay, let me just repeat the lineup of webinars we have for January 2021. So the first one is on the 6th of January, where we have CFD. All right, this is from Phillips Capital. That's the first one. The second one is another YouTuber, financial YouTuber, which has a channel where he has a channel known as Mr. Money TV lah. All right.
Yeah, my good friend.
Your good friend. So he's actually on the list. And then the third one is actually Stanley Lim. So Stanley Lim is the founder of Value Invest Asia, where he talks a lot about stocks, and it's actually he has a very global view when it comes to stock investing. So these are the 3 webinars that we have prepared. It's in the pipeline. It's gonna be held in the first half of January 2021. So make sure you stay tuned to our webinar invites for these 3 webinars. And of course, this is actually the final session of the webinar show brought to you by KCLau.com for 2020. So Kah Ho, I would like you to do the honors. Any last imparting words of wisdom for our listeners, our audience, before we go for our makan?
Yeah, actually, I just want to thank KCLau and Ian again for making it possible for me to actually share my experience and all this case study. In fact, I'm very happy, because we're all into this journey about spreading financial education and financial literacy. I'm so glad that you invited me, and looking forward to have many more of this kind of sharing session. If you guys really enjoyed today's session, and again, maybe the last word would be, I hope you guys from today's session be able to find that true north that you're looking for in 2021. And we know that 2020 has been a very challenging year. I just wish you guys 2021 to be a magnificent and awesome year moving forward. So thank you very much again, Ian, for having me. I'm so glad to be able to do this session with you.
Okay, thank you so much. All right, for those of you who wants the recording, all right, who wants the replay, go to KCLau's Money Tips Facebook page. So we are gonna put that up for 7 days, where you can actually watch the whole show for free, but it's only for 7 days. Okay. So with that, I would like to wish all of you, okay, it's a belated Merry Christmas, but more importantly, it's now Happy New Year 2021. All right. So Kaho, I will see you again. And for the rest of you guys, see you next year. Goodbye.
Bye.